It's time for a portfolio review as we reach year end. Stick around for this episode of Something More.
Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president and financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Thanks for being with us. I'm here with Jeff Perry and Brian Regan with Wealth Enhancement with the AMR team, and glad to have you joining us for our segment this time, thinking about year-end considerations for your portfolio review. You know, throughout the year, we meet with clients regularly every month doing portfolio reviews or annual reviews, which is not strictly limited to the portfolio. And it seems as though some people come in more regularly than once a year. You know, some are quarterly, some are semi-annually. Well, in any case, as we get to year end, we really start thinking about, well, what should we change? And that is to say, the public thinks this way. We're trying to think about it all the time and making adjustments throughout the year. Brian is our senior portfolio manager, and with each quarter, Brian, you give a webinar and a newsletter to give our clientele a sense of the things that are going on in the market and how that's working into our strategies and things we want to address and adjust. But at this time of year, I think we hear a lot more about time to do a portfolio review. And let's talk a little bit about some of the kinds of issues that listeners may want to be thinking about if they're not doing this, or if they're not getting this kind of assistance from their firm that they work with. If they work with an advisor, if they're doing it themselves, maybe there's some things they can glean from our counsel here as far as some things that they should be thinking about. And incidentally, there was an interesting article in the Barron's magazine. I still get the paper version on the weekends. Get it on online as well. But this one was inspired by one of the contents of the magazine where they're talking about year-end planning. And you know, Brian, we just did an episode not long ago where we were talking about some of the thinking about next year and some predictions. And this kind of fits in with some of that thinking to start with, because as you look at your portfolio, you want to be thinking about what's ahead. How does that impact what I might be considering as I look at my portfolio and changes that I should be addressing? If we haven't a disciplined process, we tend to have things drift and move away from where we might have originally wanted them to be. Maybe talk a little bit about just that kind of a process, that thinking about where things are going is really important. You know, go where the puck is going to be, right? And that notion of having an insight to the thought process about what's happening, as well as the idea that things change over time and you don't want to just be complacent.
Yeah, we have a process that we call the active allocation, and that active allocation is trying to make intelligent asset allocation decisions. Not all the time, but quarterly we revisit the data and the facts, and we try to make smart decisions. And over time, I'm not shy about saying I think it's worked out very, very well. And I think we have added value through asset allocation, which many people would say it isn't possible. I've got the facts to back it up. It's very much possible. And I think, Chris, what you're saying is right. We do a lot of things that aren't intuitive, I think, and that's important, right? You need to have a thesis and a reason for what you're doing. And it did well last year is not a good thesis, right? And I think you were mentioning earlier that in Barron's you read that your bonds are back. Well, sure, it's so far this year, it's up. The aggregate bond index has done 7%. but by definition, that means there's less opportunity for 2026 as there was for 2025. So when people wrote similar articles in 2025 about how bonds are dead or the 60-40 portfolio is dead, they were missing the whole point. The bonds were getting more and more attractive for the future, right? So this is a long way of saying, past performance isn't indicative of future results. And you have to think about what could happen in the future, what's likely to happen in the future, what's more probable than not. One of the things that I've struggled with over the last 12 months has been the huge performance in gold, for example, right? How many people have asked us about gold over the last 12 months?
Many.
And my reasoning for not owning it has been, I don't understand what's driving the price, or now that I think I have a good understanding of what was driving the price, but I also think that could change. And if that changes and you get rug pulled, that doesn't help you, right? So the fact that we weren't in it until the fourth quarter, is tough, but I understand why we weren't in it. And I think that's a really important distinction, and that differentiates, an investor that has a good process versus someone that got lucky on a trade, right? And we invest for decades. Hopefully, I'll have a nice long life, and I'll be investing for the next few decades. And I'd rather have processes that will help me continue to do well for the rest of my life, rather than getting lucky with a price movement. And those things can be tempting. I'll be the first.
And now that said, I mean, not all of our clients think in terms of decades because of their age and thinking, I don't know how long I have kind of mindset. But some of those people do think longer term because they're thinking generationally. But many times they're thinking more about their mortality and their, they want to be less aggressive and less exposed to risk. But that enters into their allocation decisions as we think about it. When it comes to the investment decisions that you select, you're doing this review multiple times throughout the year. We have sort of a schedule. Of course, markets don't always move to our timing of things. And I just want to be clear, what we do is not really timing as much as paying attention to what's going on in the world. We're not trying to jump in and out of markets. What we're trying to do is see what's happening in the world and where there's opportunities, where there's risks, and adjust accordingly. That means maybe we want to have a little more of this, a little less of that. Or perhaps some sector exposure that, or an example of your reference to gold earlier. These are things that we have some core positions that we hold on to, and we make some adjustments with some more tactical positioning based on what's happening with interest rates, what's happening with stock valuations, what's happening with yield spreads, or whatever it might be. There may be drivers that can say, okay, we think there's opportunity, or conversely, we think there's risk, and that has an impact. When you're thinking about your portfolio and looking ahead, it's important to have those kinds of thoughts about what the future may hold and how that can work into your strategy thematically, as you said, Brian. And then not to be complacent. We see this often where people have had investments that have done well and enjoyed how well they've done, but it turns into increasing risk in their portfolio because of outsized growth, and that didn't trim that position to capture some of that profitability and use it to rebalance, buy something that's a little out of favor to benefit from that. We can add risk inadvertently if we're not paying attention to the portfolio composition. What was a 60-40, one decade, a decade later could be significantly different if we're not doing a regular practice of making adjustments and rebalancing. Anything to add to that before I hit on some other themes?
Well, I think one of the big things that you touched on that I want to drive home is, people do have different time horizons. People are different. You spend a lot of time when you get to know people, trying to understand their risk profiles, and Jeff does too. And that's super important, right? Ultimately, we want to we want the right amount of risk, right? If you're a conservative investor, which we define as having like a target of 50% stock in their portfolio, I'm not going to take 75% stock. That's not going to happen. We're going to work within that framework, right? But 50% stock, you have a lot of levers to pull, right? You could do sector allocation, you could do more international, you could do more growth oriented, you could add more beta, you could have less beta. You can underweight a little bit here and there. But the target is going to be similar, right? We want people to be in this in the long term, and doing intelligent things around the edges to try to drive performance through asset allocation is what I was referencing before, not the strategic asset allocation and the target of your risk profile, which should be static unless you have a big, life event. We have people who are working and then become retired, and guess what? You should take a whole lot less risk when that situation happens, right? And that would be the type of life event that I'm talking about.
It's not exactly on point for the episode, but this is really super important. If you're working with somebody who really doesn't know you, like know your fears, your goals, your life changes, they're not talking to you periodically to check in, to see if anything's changed, or all the things that can happen in life, it's really advisable to talk to somebody who knows you personally, knows all those things about you, because if somebody's giving you advice and they don't know you, that's a kind of a red flag that maybe that's not the right person for you.
Yeah, I mean, that notion of you don't want to get a prescription before you've had the
it's a great analogy. Yeah,
the meeting with the doctor to assess you, right?
Yeah.
Same kind of mindset. You want to have that kind of awareness to help inform what you might be appropriate for what's a good solution to the kind of things you want to see in your investment portfolio.
It's definitely not a one and done. You meet with your advisor and they get a perspective of where you are in any given time period. But that's why we do those reviews that you were talking about, quarterly, twice a year, annually, whatever it is, whatever pace is right for the client. And the first question that I always ask, and I know you do too, is like, what's new? And it's not just like social niceties. We really want to know, like, what's new?
Yeah. Is there a health development? Is there cash flow demands? Is there a big expenditure planned?
Did you inherit money?
Yeah.
It can be good things, right? Did you get a big bonus from work? Did you pay off something? Did you, whatever the case may be. There's so much that happens in this journey of life that it's really important that when those things happen, you need to communicate with an advisor who wants to know your situation and make those changes based upon those things that are happening in life.
And what are you guys saying, right? You're saying, was there a life event that should change your risk profile and asset allocation, right? That's ultimately, if I'm going to sum it up in one question,
it doesn't have to even change your allocation, though. It could affect how we want to be approaching that allocation, right? How much are we going to keep for liquidity and where, and how are we going to do that? Just, I don't know. You know what I mean? Like it's not always even as dramatic as the overall how it all fits together allocation. It might be how we compartmentalize that for people and generate the expectation of where we're going to take money from or whatever it might be too, right?
And it might not be, we're on portfolio reviews, but it might not even be portfolio related. It might be an insurance need, or an insurance that you no longer need, or saving for an education, in a different way, or estate planning, or whatever it is, right? So it's a holistic approach, but the underlying message is your advisor should be a fiduciary. They should act in your best interest, but they should definitely know what's going on in your life.
Some of what this article talked about, I want to come back to and bring Brian around to addressing some of these types of issues. In addition to the things we've talked about with asset allocation and rebalancing and so forth, and the idea of diversification in various ways. One of the things they discussed was the idea of equal weight investments versus cap weighted. The idea that perhaps in a lower interest rate environment, it can be more attractive to smaller companies. And we've heard so much about this concern about concentration at the top of the index I just thought that might be an interesting thing to just weigh in on for a minute or two. Just your thoughts as it relates to things like equal weight indexes as compared to a cap weighted index. Anything you want to add to that talk?
It's interesting that you came around there because I wanted to jump in with something along those lines. Those articles are hard to write, right? They're trying to do a one size fits all, and
Yeah.
those rules don't apply, right? Every circumstance is different individually, but also each market is different, right? So I get what they're saying. With lower interest rates, you might think the smaller cap stocks might outperform, but are they indebted in ways like private equity or private credit that we've talked about? There's shown to be lots of issues in.
Have a lot of risk.
Are they more exposed there, right? Are they more exposed to industrial type companies like real estate, for example, which is a suffering sector right now? Those are things to consider, to look through rather than just do rules of thumb. When it comes to like asset allocation, Chris was talking about equal weight versus market cap weight. I'll answer the question, but I want to do it in a little bit of a different way. Some people I have found, Chris, that are obsessed with dividends, and they might have a 50-50 portfolio, and 50% of the portfolio is in dividend stocks. And this is a huge mistake, right? When they look back at their portfolio, they're like, "How come I'm lagging so much?" Right? I'm a conservative profile. I got 50% in stocks, but my performance is, the S&P 500 is up 18%, and I got 2% on the year, right?
So
and
whatever it might be, yeah.
My bonds outperformed my stocks, and they're left puzzled. And this is the kind of thing that we try to teach people, right? We don't just try to get their business. We try to teach them why we're doing things, and that's part of the quarterly that we do, quarterly webinar and the quarterly letter. And you guys do an excellent job, meeting with people and trying to not just show them their performance and get to know them, but try to explain to them why they have what they have, right?
Yeah.
That's that can make a huge difference, right? So you could have one investor that's 50% in equity and one investor that's also 50% in equity, and the investor on my right hand is much wealthier than the investor on my left hand, just because of how they've allocated their portfolio. One might have gone with the market cap route, and one might have gone with the equal weight route. And the one with the equal weight, as of today, is not doing nearly as well as the person in the market cap weight. So, there are pros and cons to equal weighting, right? If you want to equal weight because you're concerned about an AI bubble, for example, it might be rational, it might be good for you. But another thing you could do is just take less equity risk altogether, right? You kind of wanted exposure to the winners, right? Chris pointed me to an email from a client the other day who is very concerned about an AI bubble, and his points were reasonable. They were rational. And my answer was, well, if I just own the S&P 500, I would have 8% Nvidia, but I don't. I own, we're a little bit more tactical in our portfolio, and I own 5% Nvidia. And that we haven't given up any performance being 5%, right? You make it up other places. You have other ideas that work elsewhere. But I don't think, and I've been harping on this to anybody who listen, it's not an all in, all out approach. It's all you should think of probabilities. You should think of probabilities when it comes to your asset allocation. You should think about how much downturn you can withstand. Right. I wrote an email to a client yesterday comparing two portfolios, his existing portfolio and our portfolio. And, I was comparing both the return and the drawdown metrics. And, these portfolios were 100% in stock. So the drawdown metrics were large. Right. And my point was, look, in this portfolio, you're actually getting more return in a very similar drawdown. So this is a better portfolio, despite it being, a very large drawdown. So that might not be appropriate to be in 100% stock. But if it is, this is a better portfolio. And I can make a less risky portfolio by marrying this better equity portfolio with a fixed income portfolio. So, there's a lot that can go into this. but on the face of it, you can look like you're doing the right things, and the money just won't follow if you're not paying attention to and learning what the right things are actually to do.
Very good. Jeff, one of the interesting things mentioned in this article as one of the things to think about at year end was the idea of consolidation, because they said nearly a third of retirees have at least 2 or more 401ks that they've, maybe moved on from,
Former employers, right?
Former employers. So, that's a great example of the idea of trying to bring a little simplification. I spent time with a client just this week who was a new client. And, it's hard to give up what's familiar, because we get run into routine of like, oh, I've got 10 bank accounts. I've got, an investment over there, a mutual fund company I've had forever. I've got, maybe drip stocks somewhere else. I've got brokerage account A, B, C, and there might be reasons of how it all came about. But at some point in time, you find, I don't think this is being managed thematically, as Brian was talking about, the way we think about portfolio construction. Similarly, we want to be somewhat thematic about why do we have different accounts and what's their role in the process. Oh, this is my liquidity money. This is my next source of resources. This is longer term money. We want to think about things in different ways, perhaps, but ultimately, when we can, we want to try to find ways to streamline what we're doing and be thematic. There's a whole lot of ways in which it can make life a lot easier. Yeah, right. I mean, to keep track of rebalancing or other issues, boy, that can really be a nuisance when you've got so many accounts.
Yeah, so that's someone with a lot of accounts who have specific purposes for them, and that they are going about a process of rebalancing and keeping their asset allocation consistent is virtually no one. Meaning we have a process, we have a system, we have a guy, Brian, dedicated to this stuff full time. But the average person that we see coming in as a client, and very common to have multiple old accounts here or there, or something maybe they inherited, a former employer, maybe they had this savings for a purpose and they didn't need it, is that they have them. They might not remember them all even. We've had clients who later discover and they say, oh yeah, I forgot about this one, especially now that we're all online, right? And most people have their account access online, and
you don't always get the paper that you used to get to remind you.
And if you
that would be the greatest surprise, right?
I guess it's true.
It's not a bad surprise.
It's been compounding for 20 years. I forgot all about it,
For
Go buy a boat. That sounds
or
great.
It's been declining for 20 years because it was all in some mishmash.
A lot of times
stocks
because it hadn't been planned properly, and
that reminds me of those stories you hear that people have, like Bitcoin they bought in 2010 on a flash disk somewhere, and they're like frantically looking for it.
That's the worst. But to your overall point, Chris, it does make sense to consolidate. If you have retirement assets here, there, and everywhere, 401ks and deferred comps or whatever you have, it does make sense to consolidate, if for no other reason is to make sure that the investments in that consolidated IRA now, for example, are working with the appropriate risk tolerance that you have today, and that it is invested in a way that you are comfortable with today, consistent with your financial plan, your goals, and your risks.
As we kind of wind down anyway, this is where we wanted to wrap things up. I just want to extend the invitation to our listeners as they think about year end and the beginning of a new year. It is the ideal time to think about consulting someone for a second opinion.
Absolutely.
If you're doing things yourself, or if you've had some help, but you find it's not proactive. They reach out to you when they think they might want to sell you a new product, or there's a new sales opportunity involved. Not what you necessarily want. Are they a fiduciary? Are they looking out for your best interest? Are they planning things thematically, as we're talking about? If you're not finding that kind of guidance, or if you're just doing things yourself and trying to say, what am I missing? I may not be tuned in. We often find people say, I used to love doing this, but I find it to be a little bit more of a burden at times.
Yeah,
I want to be
very
out
common.
doing other things, or if anything happens to me, if this has come up, I had a health scare. I want to make sure that if anything happens to me, my spouse will be okay.
Right.
And so, we think in terms of those kind of scenarios where sometimes it does turn out to be a good time to get a little bit of assistance, get a second opinion. And if we can be that resource for you, we're here to help. So our information will come as we close out the show here. If we can be a resource to you, don't hesitate to take advantage of our 2-part complimentary portfolio review process, and which involves us putting context of a financial plan together. So with that, Jeff, thanks very much. Brian, we'll catch up next time. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901, or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.